Well, if you're retired, you need money, right? You need something going into your checking account every month. And ideally, you don't want to be selling because of times like these, whatever the news of the day is. And if that sale order goes through on that bad day, you lock in those losses. They don't ever come back. The rest of your money can, but not the money you spent. Welcome to Wealth Creator Radio, where we help people overcome the uncertainty of having enough retirement income. I'm your host, Eric Heckman, a certified financial planner with over 30 years of experience. We want you to enjoy life and not have to wonder where your money will come from and how long it'll last. My mission is to show you how to develop a personalized income plan so you can retire more and have worry less wealth. Here at Wealth Creator Radio, we cut through the noise and get straight to what matters. We understand that the world of retirement planning can be filled with confusing products, ever-changing tax laws, and volatile markets. That's why we're here to help successful people like you navigate the uncertainty and create a blueprint for a thriving, work-optional life.
Hi there, welcome to our show. I'm Luann Fulmer. And there is no shortage about the headlines happening with the conflict in Iran. We are hearing everything from spiking oil prices, meaning rising costs at the gas pump, and then concerns about how long all of this may last. Well, never fear. Eric Heckman is here, president of Heckman Financial, here to help us make sense of all of this. But before we do get into our show, I want to make sure that you understand the opportunity that you have today. If you're concerned about these headlines, you can call Eric and our team, at Heckman Financial for a free retirement stress test to see where you stand right now with your retirement. This is a no cost, no obligation appointment. 800-454-1184. Call or text the word visit. Another thing you can do is get our digital toolbox. It includes the book that Eric has written, Blueprint to Worry Less Wealth, which is what we want for you. And then other resources for your retirement. Just text the word toolbox to 454-1184. Remember, this show comes out as a podcast every Tuesday. So just look for it. Wealth Creator Radio, wherever you find your podcast, on YouTube or whatever. And remember, find us online at wealthcreatorradio.com. So with all of that, Eric, I'm so happy to be here with you today.
Yeah, no, it's great to be going over, some hopefully some calmer, more rational stuff than all the craziness stuff that you're hearing everywhere else, right?
Right.
So,
it is.
And what you should do and shouldn't do, right?
Mm-hmm, exactly. So yeah, let's be calm about all of this. So let's start with the reports, that our energy prices are on the rise. How much could this conflict impact inflation and, just the economy overall?
Well, the ironic part is usually the main inflation number that the government uses. They ignore food prices and energy. Duh. Those are two of the biggest things. So on the government side, you might say, oh, inflation's not that big. But yeah, it's definitely going to drive up prices because of, just shipping stuff, moving stuff around, right? I mean, it's just, a lot of stuff goes on trucks and, so that's going to cost more. And ironically, after we got rid of incentives for, electric vehicles, after, we got rid of that, Trump got rid of that with the last tax law. He got rid of solar tax credits at the end of the year last year. And now we're having oil spiking from wars that he started. So, kind of interesting. I'm sure some people were invested heavily in oil that know him, but, the hard part is for the rest of us, we weren't. And, we're going to pay the price. Everything's going to get more expensive here for a while. And, and that's going to keep filtering through for the longer it goes on.
So should we be concerned about trends like this? Everybody listening, I know they are concerned, but how concerned should they be?
Yeah, well, I mean, one of the harder things with this is, in terms of what kind of concerns, right? Do I regret having my middle son go pick up my youngest son from college in our RV? I'm going to probably regret that decision now because that thing does not get good gas mileage. And, in hindsight, maybe if we filled it up beforehand, but you'd still have to get another tank on the way. So, there's those types of things. So people might maybe rethinking, car trips, other things like that. And of course, what's happening is, with airplanes, not only the TSA issues, but on top of that, we've got spiking jet fuel prices because of oil going up also. So, so a lot of travel is going to get more expensive, and that may make people rethink stuff in the short term, but long term, I mean, there's, if you're talking about retirement plan, you're talking about all the other stuff. You're not, this should not be a big deal. This is just another little blip that's going to happen. And, if you're talking 30, 40 years of retire, of growing that money, it's going to be a little time frame, but it is something in the short term. So if you need that money out sooner, that's where it's going to be a little bit more painful.
Right. Okay. So looking at the long term, we can't predict the future. So what about, or what would be concerns for us about a prolonged conflict if things do continue?
Yeah. Well, the more unstable that area gets, then, more gas and oil goes up, then higher and higher inflation. The higher inflation will not allow the Fed to lower rates and may actually make them, raise rates. And so, that could affect credit cards, mortgages, other things. So, it's one of those things where the longer and longer it goes on, the more and more damage it's going to do to the economy and overall. And, we're the ones who started it. So that's the hard part is, we only have ourselves to blame. So, a little tougher, but, again, it always goes back to having a plan. If you have a plan for, your retirement, you can run these numbers in your income plan and say, okay, did these things change? Obviously for clients who are retired, it's maybe not as good a time to be taking money out of the market, but might be a great time to take money out of those guaranteed and protected assets that you have. Now, if you have no protected or guaranteed assets, that's not a good plan because there's always going to be these bad times that come up. And if you're getting close to retirement, you really need some of those protected assets. So again, that's something where, you might want to reach out and talk to us about these things. The easiest thing to do is you can download a lot of great tools in our toolbox. We've got really quick reads on, will my money last as long as I do? Things like, am I paying too much tax in retirement, Social Security timing, copy of my book, Worry Less Wealth, and a way to talk to us here at Heckman Financial. So all you have to do is text the word toolbox, 800-454-1184. Again, text the word toolbox, 800-454-1184, or click the link below.
And we're so happy you joined us today. I'm Lou Ann Fulmer here with Eric Heckman, and this is Wealth Creator Radio. If you are just joining us, we're talking about the Iran conflict and how wars and political unrest around the world could impact your finances in retirement. So let's get into the market, Eric. What kind of challenges could a prolonged war introduce for all of us or those of us relying on our portfolios?
Yeah, well, like I said, for those people who are retired right now, they really should have three types of money. They should have market money, steady income, and foundational assets. Steady income is stuff that pays high dividends and good cash flow. And why do you need that? Well, if you're retired, you need money, right? You need something going into your checking account every month. And ideally, you don't want to be selling because of times like these, whatever the news of the day is. And if that sell order goes through on that bad day, you lock in those losses. They don't ever come back. The rest of your money can, but not the money, you spent. And, then with those foundational assets, these are things that are protected, but can earn, 5 to 8% easily over time. And, they have no downside, so those are great assets to have in this time of economy wise and stuff, right? When you have these downturns, you can take that money out of that account and then you're not locking any losses. You're protecting your money. So, that's one of the biggest things is making sure you have that allocation. And if you don't, and you're getting close to retiring, you go get it now. Right.
Yeah, so, exactly.
And there's even some of those protected accounts that give you bonuses to give you extra cash right away. And those can be really good for people who are, maybe just had a downturn and they need the money soon. Then it can give you a little bit of a kickstart.
Yeah. It seems like there's always some type of a solution or a tweak or something that you can do to help people. And so as this whole landscape continues to change, the conflict in Iran, it is important for retirees to proactively review and adjust their retirement strategies, right?
Yeah, well, you always want them, it's kind of like the GPS in your car, right? You don't have to look at it every minute, but, you do want to look at when's the next turn, are you still on the right road or is it recalculating because you missed something, right?
Yeah.
So same thing here. You can kind of count this as another little recalculation, right? And Where's your plan headed now? And does this make a huge difference or just a small difference? And, again, it's really more about, how to lay out things, how to make sure you've got the right mix. Where should you be taking the money from right now? And, which assets should you sell? Which types of monies, if it's tax deductible, tax free, all those types of things. So, again, having a plan for that is the best way to go. So to get some of that information and get the access to our toolbox, just text word toolbox to 800-454-1184. Again, text word toolbox 800-454-1184 or click the link below.
Are you happy with your Medicare plan? Even if you are, what was good for you this year might not be what's best for you next year. The team at Heckman Financial can help you sort through all the options to find the best one for you. Call now, 800-454-1184. That's 800-454-1184.
Hi there, I'm Luann Fulmer here with Eric Heckman. We're so happy to have you along with us today. Imagine you are driving your car on the highway and, when you're miles away from your destination, you can go as fast as you want to go. But let's say you're pulling into your driveway. Obviously, you have to slow down, right? You can't go 70 miles per hour into your garage. You're going to crash, right? So, Eric, what we're going to do is we're going to talk about this same logic that will apply to our retirement portfolio. Why do you say that many retirees, even pre-retirees, might be driving their portfolios too fast?
Well, hopefully they're not crashing through the back of the garage or something.
No. All the way through.
Yeah. Well, when we bought our house, there was an older gentleman that lived there and stuff, and they cleared out all the junk in the house to make it look nicer, but threw it all in the garage. So we couldn't see the back of the garage. And the back of the garage, when we moved in, it wasn't touching the foundation because somebody had obviously gone through the garage and went in with too much time. So yeah, no, I am familiar with that concept, but yeah, it's not, you're not supposed to be like some sort of Hollywood movie and slide in or have your car go sideways. Like that's not how you're supposed to run your retirement. Like slide in at the last second and be perfect.
Yeah.
No, you don't want to do that. And so lots of times you'll have too much risk, especially one of the weird effects that people have is, I always remember this from a couple that I met back in the, after the .com days. And I said, well, how much is your, after the crash, it's like, how much does your portfolio go down? She goes, oh, no, I'm very conservative. Well, her husband had picked her 401k allocation and he was super aggressive. And so even though she was older and thought she'd, lower down her risk, he had done the opposite. And so she had big losses. And, that's what you can't do right before retirement, right? You don't want to have those huge losses. So you should be kind of slowing down, right? Like you said, before you make that turn in, slowing down and, getting some brakes, not hitting the gas and, not doesn't mean you have to like stop in the middle of the street, right? But you do want to slow down. You do want to make sure you make the turn, make sure you can stop okay, right? And get into retirement at the right pace. So yeah, if you get too much risk, it can really come back to bite you if you don't do anything about it.
Yeah, that makes a lot of sense. You don't have the time to recover that you used to. So to help fix this, Eric, there's a famous guideline in the financial world, you know it very well, called 100 minus your age rule. So talk about how it works.
Yeah, and you've seen people sometimes talk about, oh, should it be 110, 115? You always hear that when things are going better. So people kind of try to cheat the rule a little bit. But it basically just says how much money should you have at risk. And one problem I have with that rule is they say, well, okay, the other part would be bonds. Well, bonds still have a risk. So, that part of the rule, I'm not as big a fan. I think what happens is you should have more and more money guaranteed and protected, not with bonds, because bonds, unless you're holding them to maturity, that you can lose money. And we saw bonds take a huge hit in 2022. And so, yeah, what you want to do is 100 minus, say 65 is 35. So that means, you should really be only having about 35% of your money in stocks, which, that might be a little bit low. You could probably have a little bit more growth, but you do want to have a good portion of that money locked in, guaranteed. But today's world, you can have stuff that can average 5 to 7% on that guaranteed side of the world pretty easily. So it doesn't have to be a bank account. It doesn't have to be a savings account. It could be other things that are out there. But yeah, if you're putting into bonds that also can drop, may not be the best way to go.
Some viewers might be thinking, well, the market always comes back eventually. We've always heard that. So tell us why relying on that market recovery is actually kind of dangerous for someone who's already retired or close to retiring.
Well, so the hard part about retiring is you're doing the opposite of what you've been doing, right? So if you're just dumping money in, you're kind of like, say you're going forward, kind of using that car example again, right? And then all of a sudden, you know, maybe you pass the parking spot or whatever. You got to back up a little bit, right? Or probably better thing is, okay, now I'm going to get off the freeway. I have to go down that ramp and do that, cloverleaf U-turn type thing, right? And now I'm going to be
Just
going.
did that recently.
Yeah, and now I'm going to be going the other way. And so what happens is once you start going the other direction, you're taking that money back out. If you take money out and the market's down that month because of whatever, a president said something, the Congress did something, whatever, there's something in the world happened, and for a couple of days the market dropped, and you took that money out to live on that month, you locked in those losses. You locked in that lower rate. You locked in all that stuff, and those shares don't come back. So really what happens is the strategy of retirement has to be very, very different, because as you take that money out, those ups and downs really matter. So one of the things that we've set up is a digital toolbox where you can go grab stuff to read. I think education is super important. So these are, 10 to 15 page things that are pretty easy to understand and kind of give you some food for thought. So one of them is, how do I make sure my money lasts as long as I do? Am I paying too much money in taxes? Those really go along with that withdrawing money issue. You can also get a copy of my book, Worry Less Wealth. And if you want to set a time to talk to somebody in our office, so all you have to do is text the word toolbox to 800-454-1184. Again, text the word toolbox, 800-454-1184, or download it online with the link below.
You're listening to Wealth Creator Radio, watching Wealth Creator Radio. So happy to have you along. I'm Lou Ann Fulmer with Eric Heckman. And, it is scary to think that, you're going to work your whole lifetime. You're going to accumulate that nest egg. And then, so much of it could be lost in a matter of months, depending on what's going on with the market. So if someone is worried that maybe they have a little more risk than they should as they're listening to us, what would you recommend as the first step they should take, Eric?
Well, so you really need to have a good portion of your money in foundational assets. So foundational assets are very clearly defined by me. They are stuff that is guaranteed by something to not go away. So the only three places that can guarantee that would be the U.S. Treasury, banks, which is really using U.S. government as backup, right? And then insurance companies. And those are the three places that you can go to have guaranteed money. And if you've got enough, which would be at least 6 months of your normal spending, or maybe even up to a year or two, if you've got that money sitting there guaranteed, then you don't have to lock in those losses. You're not going to have to worry about those downturns, because they're going to, they will affect your other assets, that's for sure, but they're not going to at least affect your withdrawals. And that's one of the key parts. Now, also as part of that, you might have to do something with your, withdrawal rates, right? I mean, if it came back like another 08, 09, yeah, maybe you do lower down some of that withdrawal. But it's also, if you have some guaranteed lifetime money that you can keep taking, you don't have to worry about a lot of that stuff. So again, it goes back down to having a plan that covers everything in all markets and all time frames, because most of us are going to have 30, and nowadays you might even have 40 or 50 with all the advances with AI and medical technology. So you might have, way longer in retirement than you did in working life. And so you got to make sure that money lasts. You got to make sure that money's there, and you got to make sure you're protected. So, I think that's one of the problems that people don't really fully understand. And most people are investment managers in this field. They're not full retirement planners. So that's why it's really critical to have somebody that you're talking to that really knows the withdrawal strategy. How do you take that money back out? And so, that's the key thing. So, if you've got questions, if you need to get a plan going, if you want to get a little bit more information about that, like how much money am I spending in retirement? Will my money last as long as I do?
All those great resources are up in our digital toolbox. All you have to do is text the word toolbox 800-454-1184. Again, text the word toolbox 800-454-1184, or go online and click the link below.
Do you know whether your retirement plan has any weak points? Discover ways on giving your financial future the proper tune-up. Simply go online to wealthcreatortoolbox.com to gain a better understanding in taxes, Social Security, and other ways to manage your portfolio. That's wealthcreatortoolbox.com.
Hi there, I'm Luann Fulmer here with Eric Heckman, and today we've been talking about ways to balance risk and reward using the 100 minus your age rule. Now, traditionally, the safe part of that equation has been bonds. But Eric, lately the bond market has been anything but boring. So I want to talk about how a person knows if the safe portion of their portfolio is actually safe.
Yeah, well, that's the big misnomer, I think, in our business is, how people say, oh, lower your risk by having bonds. That's kind of like saying, okay, I'm gonna not run across the freeway. I'm only gonna run across the road. They both have risk, so you're just changing the risk, but that doesn't really help, and they're not safe. I mean, the only time that bonds are safe and guaranteed is if it's the U.S. Treasury that you hold to maturity. So if you're holding a 30-year bond, well, that's a long, long, long time. So most people don't do that. Now, if it's a year, 2, 3, okay, but beyond that, those are not guaranteed. And if rates start going back up, those bond values go down because people can now buy higher yielding bonds, and so why would they buy your bond? And so if you need to get out, you need to have money to live on. That's beyond just the dividends that they pay. Yeah, you're going to have to sell that and take that loss. So that's definitely not something that's guaranteed or protected.
Okay. Eric, can you give us an example? Because you have lots of experience. Over 30 years, you've seen it all. Give us an example of how two people the same age might need totally different investment strategies.
Yeah, well, I mean, obviously, it really depends on what their assets are like, right? If you've got a couple $1,000,000 and, with Social Security, you could probably have a lot of that portfolio, just take the interest off of that and be okay. And so maybe bonds might work out. But again, I would look at other things because lots of times there's insurance products that have higher interest rates than bonds and have true guarantees where they don't go away. And you could even usually take parts of your principal without having to worry about ever taking losses. So, there are a lot of different options. But, if somebody who's got less assets and all of a sudden that bond market tanks, which might mean the stock market's tanking too, like it did in 2022, then what do you do? Now that person's really, really stuck, right? Because of now they have no place to run, no place to get the money, and they need the money. They're going to need to do those withdrawals. And so that's going to speed up their portfolio shrinking. And it's one thing if you're 85 or 90, but if you're 65, that's a little freaky. So that's where having a better plan is going to really come into play, and making sure you have some money truly guaranteed.
Yeah. So it's obvious and clear that two 65-year-olds are going to need completely different plans. So, there's general rules of thumb that have limitations. So talk about how you decide what's right for a specific person or couple. You've talked about this before.
Yeah, well, I mean, it all starts with a personalized income plan. So a personalized income plan, really what that does is that says, okay, this is how much I spend on a monthly basis. And some people, they want to do cruises. They want to do Europe trips. They want to do all this stuff. Some people just want to do their hobbies around the house and not spend much, right? So depending on what that spending level is, it's going to be a very different, picture. Do they have a mortgage? Do they not have a mortgage? Those types of things. So yeah, you have to have that customized income plan. And once you have that, you go, okay, I've got, this much in my 401k, that much in my IRAs, this much in my, brokerage account, savings accounts. Where should I be getting this money from? Where are those different spots? How long is that going to last? Is there going to be enough there to make it through? And then what's my lifetime taxes? That's the other part people don't pay attention to is lots of times they just say, oh, if the market's down, they'll take money from my savings account, or I'll do this. Well, should you have taken some money from your IRA and converted it to Roth when the market was down? Because then once the market goes back up, it goes back up on the tax-free side of the world. So, there's a lot to be thinking about. There's a lot to be looking at, but lots of times people just kind of blindly just go along and do whatever's simpler and don't really think about the 15, 20, 30-year consequences of those actions because usually most people aren't talking to them about that, unfortunately. And
right. And that's what, yeah.
Yeah. So I was just going to say, that's what that income plan does. It really shows that. And so one of the ways that, you can get access to, will my money last as long as I do? When am I paying too much taxes in retirement? Those types of things. We've got some great reads in our digital toolbox. And all you have to do to get that is just text word toolbox to 800-454-1184. Again, text word toolbox, 800-454-1184, or just click the link online to download it all.
And guys, this is complimentary. I want to reiterate that too. So, that would be something for you to take advantage of right now and do it today. Don't wait any longer. I'm Luann Fulmer here with Eric Heckman. This is Wealth Creator Radio. It sounds like relying on just any generic rule of thumb could actually hurt you if you're not accounting for your own specific income needs. How do you help people find that balance?
And I mean, it's a really good question because the rules of thumbs are just always that, right? They're just, okay, what's an easy way to basically say something that hopefully covers everybody, right? But is it really accurate or not? It's basically, if it's that generalized, it's never going to be right because it's not about you, right? And so that's one of the things you want to look at is say, okay, for my situation, does this make sense for what I want to do? Because I've had some people, one person, I couldn't believe it. She could live on $3,000 a month. And, when I looked at everything, I was like, okay, yeah, I guess she actually can.
She's doing it. Yeah.
Yeah. Her house is paid off. She didn't like to travel, didn't like to eat out much. It's okay. Well, if you're, if that's the way you live and stuff, then yeah, you've got enough. But then there's some people where it's like 15 grand isn't enough a month. So, you just gotta go, okay, well, what works for you? And yeah, that's where you want to really have a kind of a good plan to say, okay, for my situation, this is what makes sense, for our situation, or if it's you or your significant other or whatever. So yeah, and that's why it's so critical to have that income plan.
Yeah. And that's why, we're talking about people giving you a call, you and your team, put together a blueprint to worryless wealth. That's what we want for you in retirement. Worry less about your wealth. So you need that guideline that is going to match your specific retirement journey. So, for people listening, watching who want to move beyond these general rules, talk about just the value of getting a second opinion on their current plan.
Yeah, well, you never know what you don't know, right? And when would you want to know it? Of course, is right away.
Sooner than later.
Yeah. And so, yeah, you might think you're all set. You might have an advisor who's doing a good job, but maybe they're more accumulation advisor and they're not really a retirement planner. Yeah, there's lots of different things that really dictate, say, okay, maybe I should reach out and find out if there's something better out there, if there's something different. What should I know about? And, that's one of the things we can do is we just tell you, okay, here's where you're headed. No right or wrong. It's just, this is your direction. And if that's not where you want to go, we'll tell you, okay, here's where you need to make some changes and to get to your right destination. So, that's, I think, one of the most critical things to do is make sure and just do a check-in. So yeah, if somebody wants to do that, super easy. All they do is text or visit to 800-454-1184. They can actually call or text or visit to 800-454-1184. Or click the link if you're watching online.
Be sure to like and subscribe to Wealth Creator Radio so you can stay up to date on ways to build your wealth and create a retirement you and your family will enjoy for years to come. Like and subscribe today and create your wealth for tomorrow with Wealth Creator Radio.
Hello, and thank you for joining us today. I'm Lou Ann Fulmer here with Eric Heckman, who is passionate about helping retirees like you have that remarkable, worry-less retirement. So we're going to get into some questions again right now in our show. I always love this segment, Eric, where I ask you common questions from retirees. You ready to go?
Yeah, no, definitely.
Okay. All right, very good. First question comes from Tammy. She says, what kind of accounts need beneficiary designations, and how should I be checking and updating these designations?
No, that's a great question because we've seen some weird things with, like, sometimes companies change their 401ks. You had the whole TD takeover by Schwab, where a lot of beneficiaries were all of a sudden missing, and they were there before. So, I've seen this before where computer systems just update and then they go away, or sometimes people just don't pay attention, and they're like, oh, well, hold it, that's my ex on there. Right. And so you don't want those types of things.
No.
So yeah, I mean, in terms of frequency, that's probably a tougher question. A lot of companies now have started putting it on some of the statements, which is nice, and I think that's really helpful when they do that. But yeah, I mean, I would say maybe at tax time might be a good way to look at all those documents and look at that. But yeah, definitely it's good to go through everything. And, IRAs, annuities, life insurance, 401ks, those things all have to have beneficiary designations. But the part that a lot of people forget is the other stuff. So, your bank accounts, your checking accounts, things like that. You can do a payable on death, so POD designation, which is like a beneficiary. And then if it's a brokerage account, so like just a normal investment account, you can do a thing called TOD, transfer on death. I don't know why they can't kind of come together and use the same term.
Exactly.
It'd be a lot nicer for people, right?
Yes.
But yeah, so that'd be one thing. If you have a trust, then the trust really should own brokerage accounts and any large savings accounts, because then you get some extra benefits for that. But yeah, at the minimum, make sure you get those designations right, because I always tell people settling somebody's estate's a ton of work when it's in good shape, but if it's in bad shape, it's a lot of work. I mean, it's more than a full-time job. So
Right.
yeah, you don't want to leave a mess behind.
Right. And Eric knows what he's talking about. He's been doing this for a long time, over 30 years.
Yeah, we got several death claims going right now, unfortunately.
Oh, wow. And I will say, my husband and I recently, I'd say within the last 2-3 years, he made sure to put me on all the bank accounts. I wasn't on all of them. So he was like, oh, we better do that.
Yeah.
I was like,
actually, one of the weird ones is utilities.
Yes, there you go.
Yeah.
That's a good one.
Utilities, lots of times, like sometimes your cell phones, sometimes your electric, sometimes it's only in one person's name. So
Good point. Very good point. Okay, let's go to another question. This one's from Alan, and he says, how do I figure out how much I have to take from my retirement accounts? I know there are required minimum distributions, but I don't know how to find out exactly how much mine will be.
Yeah, well, I mean, there's pretty easy formulas for that. They've screwed around with it a whole bunch, which confuses everybody.
Right.
So
that's the problem.
So what once was 70 and a half briefly for 72. Now it's age 73 if you're born before 1960. And then it's age 75 for everybody else. And that's when you have to take money, or what they call the required minimum distributions. You also may have to take those if you inherit money from a parent or a sibling or somebody like that. So, and those are special rules. So it gets even more complicated. But yeah, I mean, really the goal should be, in terms of not just the RMDs, but really should be looking at an income plan and looking at that income plan and saying, okay, how much do I need to live on? What's, after Social Security, after a pension, which likely you may not have, right? After any guaranteed lifetime income sources, what's that gap? What's that delta that you have to overcome to make sure you have enough in retirement to live on? And, you can have a fun, worry less wealth type of a retirement. So, yeah. So, I mean, if you want to get a little bit more information and really, kind of get a little bit more educated about, will your money last as long as you do? Social Security timing decisions. Am I paying too much taxes in retirement? Which is very related to that RMD question. That's all set up at our toolbox. These are all quick reads, 10 to 15 page things. Get some education. You can get a copy of my book, Worry Less Wealth, and even set up a time to talk with me, Eric Heckman. So all you got to do is text the word toolbox to 454-1184. Again, text word toolbox 454-1184. And you can also download it directly at wealthcreatorradio.com.
And we thank you so much for spending time with us today. This is Wealth Creator Radio with Eric Heckman of Heckman Financial, where Eric and his team want to help you have that retirement where you will worry less. That's their goal for you, is to help you worry less about everything in retirement. And that's why we do this show. And right now we're doing mailbag questions because we like to bring these forward to Eric. He answers them on the air. These are questions that you likely have. And it's always fun to hear what's on the minds of retirees. This next question is from Walt. And he says, do I really need to be that worried about inflation? I feel like it won't be that big of a deal after I stop spending as much money as I get a lot older. So what would you have to say to that?
Yeah. So when I was first in the business, I met with somebody who he was regretting starting Social Security age 62 because he thought he had plenty of money because all his CDs were paying 7 and 8% at the time. And then they dropped to 2 to 3%. And that was a huge cut at income. And of course, inflation had come up. And so now he's got less income from Social Security, less money from his CDs, and things got more expensive. Yeah. So that is not good. That's not what you want to have. So inflation's always going to be there. It averages typically 3%, some years 0, some years, 9, whatever. But, you got to include that number in there along with taxes, along with everything else. And that should be part of your income plan.
Right. Yeah. Good point. Good point. You can't, the way things are now, things will probably change in the next 10, 20 years. So,
yep.
Okay. Next question for you. This is from Kurt. And he says, retirement's still a good 8 years away for me. What things should be on my radar at this stage?
Well, that is the time that most people actually start working with us, is when they're, 5 to 10 years out for retirement, and they start realizing they need to start shifting their money around. Mm-hmm. It's no more points on the scoreboard now. Now it's, how do I take that money and turn it into dollars that go to me every month as a paycheck so I can have fun and, enjoy life, right? And so, so you need to start restructuring that money. You need to start having some money, a lot more money in foundational assets where they're guaranteed to not drop and go away. Because if you're getting close and you got enough money, the worst thing you can have happen is a big downturn right as you go to retire, right? So we want to have a little bit more of that locked in. We want to have more paying dividends. We care now more about yield or distribution rate, because now you got to be taking money out every month, and you can't wait for it to come back. You need to, have some of that cash flow there. And, obviously you want to have a plan for how much can you spend? How are you going to get health care? If it's retiring pre-65, post-65, all these different things. So there's a lot of different things to be looking at. So that is the ideal time to be setting a time to talk with us. And one of the easiest things you can do is, quite simply, is just text the word visit. And we'll send you a link right away to book a time to talk with me, Eric Heckman. All you got to do again is text word visit to 800-454-1184. Again, text word visit 800-454-1184, or book directly online at wealthcreatorradio.com.
Imagine for a moment that an intense storm is pounding your house. Will the roof leak? Will the siding peel away? Will your basement flood? If your house is properly built and maintained, you'll be fine. But what about your 401k or your investments? The stock market has had a great run the last few years, but is its current turmoil making you feel uneasy? Are you confident your portfolio is built to weather the financial storm? Now may be a great time to have your retirement plan inspected. Call Eric Heckman of Heckman Financial at 800-454-1184 now. Eric will examine your portfolio and show you if your investments are in need of some weatherproofing. Call Eric Heckman of Heckman Financial today at 800-454-1184. That's 800-454-1184. Investment advisory services offered through Heckman Financial Insurance Services, Inc., a registered investment advisor.
Hi there. Thank you so much for spending your day with us today. I'm Lou Ann Fulmer here with Eric Heckman. We're at Heckman Financial. Their mission is to get you into and through a worry-less retirement. On our show, this is kind of the time where Eric does some storytelling We always go through, challenges and risks that exist in retirement. Sometimes Eric tells us a story where somebody, had a really good experience and made it through and conquered their challenge. But right now we want you, Eric, to give us someone who has experienced one of those retirement obstacles. We call it a financial fail.
Yeah. Well, I mean, this one's, I think it's more of a life fail. How's that?
Okay,
we don't really have a term for it, but no, so one of the problems I've seen way too often, and you hear this a lot about, adult kids, people in their 50s and 60s talking about their parents, but I've seen it with my own clients. Like I had one gentleman who was, he kept wanting to work because, if I work one more quarter, I'll get that bonus or I'll get that RSU vesting. And, he did this for 3 or 4 years until he was 70, and he finally retired. And he was going to finally start doing stuff. And right as he was, about the same time, I think it was retiring, or maybe it was a little bit before, he started having some foot issues and some other things. And then his health deteriorated a bunch, and all those trips he wanted to take, all those things, he got a couple more years of money in, but, and now he's, unfortunately, several years later, he's mostly bedridden and didn't do a lot of that stuff. And I see this quite often where they'll be trying to save more money for their kids, and the kids go use your money, go out and take those trips or fix up the house how you want it if you're going to be home more often. And I mean, years ago, I had a client that was, they had registered with her tribe. She was Native American, and all of a sudden she started getting all these huge checks from a casino, and because their tribe was running Indian gaming stuff, and so she had all this money, and they still had a little wall heater, not forced air throughout the house. They had one of those big old box TVs, the old school flat screen. And, I'm like, these improvements are less than 1 month's pay you're getting right now.
Right,
Go get them done. And, and then sometimes also people wait to give that money away. And I've had a few clients that they've realized that, I've got plenty of money. I would love to actually, give this money to my kids now or my grandkids now and see their faces. And every time somebody's done that, there's never been a bad story about it.
Right.
It's always been a very positive experience. And, so that's one of those things to be thinking about is not only, you have to have enough money saved up, but, if you're not going to use it, I mean, it's not points in the scoreboard, literally you can't take it with you.
Nope. I don't think anybody ever has.
Somebody else is going to get it regardless. And so, why don't you go do those things you want and do it while you're still healthy and do it while you still can. And, again, if you've got an income plan, you can kind of have that confidence to know that you can spend that money. And lots of times that's the problem is people just don't have that confidence. Again, that's again about asset allocation. Do you have some foundational, some guaranteed assets to make sure you're going to always be good and always be okay? Once you know that, then you're fine. Thank you for tuning in to Wealth Creator Radio. I'm Eric Heckman, and it's been a pleasure guiding you towards a more confident and secure retirement. Remember, my responsibility is to always do what's right for you, our client. Together, we can cut out that fancy sounding financial jargon that doesn't help and focus on what truly matters for your financial future. If you're ready to take control of your retirement planning and build a personalized income plan, contact us at 800-454-1184 and text the word Toolbox to schedule a complimentary consultation. If you're looking for more resources and tools to build your retirement future, don't forget to check out that Wealth Creator Toolbox, your toolkit for a secure and confident retirement journey. Until next time, retire more and worry less with Wealth Creator Radio.
Information provided during Wealth Creator Radio is for illustrative purposes only and does not constitute investment, tax, or legal advice. Information has been obtained from sources that are deemed to be reliable, but their accuracy and completeness cannot be guaranteed. Always consult with a qualified investment, legal, or tax professional before taking any action. Annuity guarantees are based solely on the financial strength and claims-paying ability of the issuing company. Individuals should thoroughly review the contract for specific details of the product features and costs. Income payments and withdrawals from deferred annuities are generally taxable as ordinary income in the year they are taken. Eric Heckman offers investment advisory services through Heckman Financial and Insurance Services, Inc., a registered investment advisor. Any tax advice given as part of this presentation is not intended to be used and cannot be used by the taxpayer for the purpose of avoiding tax penalties or promoting market marketing, or recommending to another party any matter or transaction addressed herein. The views and opinions expressed in the program are not necessarily those of the radio station or its sponsors, and they should not construe as legal, tax, or investment advice. You should always consult the appropriate advisor before making any financial decision.